In this video, we're going to discuss the basics of payroll accounting. So when an employee works for a company and earns $2,000 of wages or salary, you might think it's simple for the company to just debit wages expense for $2,000 and credit cash for $2,000. But it's not that easy. And the reason is that an employee's compensation could be subject to a number of different things. For example, the company might be required to withhold income taxes from the employee's earnings. So there could be federal income tax, could be state income tax, and in some cases even local income tax. In the United States, we also have a thing called Social Security taxes, and this will appear as FICA, F-I-C-A, and that includes Social Security benefits for people who've retired. That's what that's funding, and also something called Medicare. Okay. And then there are unemployment taxes that might be leveled at the federal or state level. And then you also sometimes have garnishments. Garnishments would be that the government has said, look, you need to withhold a certain amount of money, let's say $100, from this employee's salary every week or every 2 weeks or whatever, because maybe they owed child support or there was a legal judgment against them, and so you're going to have to garnish their wages. You're going to have to take that money and withhold it so that another party can receive it and not the person who actually earned the money. So let's get into the journal entries. Let's say that we have an employee who does work and they earn $2,000, and typically companies, they could have two different journal entries that would be, this is all part of one way of accounting for it. I'm not saying it's two separate ways. I'm talking about, I'm just going to break it up into two journal entries. But this is all part of accounting for the same employee that made this $2,000. First of all, the company's going to debit salary expense for $2,000, or if it's not a salary, they debit wages expense. But then there might be some income tax withholding. Again, what this is, this withholding, is saying that the government has assessed, maybe, so let's just say this is federal income tax. We could also have a separate line item for liability for state income tax withholding if that employee's working in a state that has an income tax. But let's just keep it simple. Liability for federal income tax, that's saying that the government has said, look, we think that this employee is going to owe some federal income tax, and we're asking the employer to hold this money back and not pay it out to the employee. So the employee never receives this $300. Okay, they're not going to receive that. So the company is holding it and remitting it to the government. Now, so the company, this is going to be a current liability for the company because within 1 year, they're going to submit this to the federal government. Then also I mentioned the FICA. This is the Social Security tax. So we've got FICA payable, okay, so $153. And then the actual cash that the employee receives is less than $2,000. So even though they've earned $2,000, they receive a little over $1,500. And if they had some garnishments or something, then you'd have garnishment payable right here. And let's say that was $200, then that would reduce further the amount of cash that the employee would be receiving. Now, these amounts here are amounts that they're taxes that the employer is withholding from the employee's earnings and then going to submit them to the government on behalf of the employee. However, the employer might have to pay the government themselves. For example, in the U.S., FICA is split 50-50. The employee has to pay half, but then the employer also pays half. Now, here, and this is where it gets a little complicated, the employer is actually withholding the employee's half. And then they're saying, okay, look, we're not going to give you this 153. We're going to hold it, and then we'll pay it to the government. You really, the employee is paying this, but the employee never even sees it. Okay, so that's the employee's share. But then the employer, they have to pay the same amount, okay, because they're splitting it. So let's say it's $306 total. This is the amount here that is being paid by the employer. Now, the employer might also have to pay federal or state unemployment tax. So let's say we've got some federal unemployment tax that's payable, and then this will also be a current liability. Okay, so that's a current liability, so because it'd be payable within 1 year. So we're going to have now these amounts. So that, and then here we've got salaries expense is what's debited for these amounts. You could put this all into one single journal entry, but I've broken it up to show you the following. These here, this journal entry right here, okay, these are amounts that are paid, or I shouldn't say paid. Maybe I should say amounts due or owed by the employer. Okay, so the employer is being subject to saying having to pay half of the FICA and so forth. Now here, even though the employer is withholding this money and actually sending the check to the government, this is really the employee's money. And the employer is just withholding it. It's just easier. The government wants to make sure they get that money. And so they're saying to the employer, hey, you hold on to that money because we think the employee is gonna owe it. So these are amounts. So this is, we've got here in this journal entry, we've got the amount of cash being actually paid out to the employee. But then we have actually also have the amounts being withheld. Okay, so that we'll say that this journal entry includes the withholding from the employee. Okay, so we've got income tax. This is actually the employee, even though the employee isn't the one cutting the check here, this is actually the employer is holding the employee's money and then remitting it to the government. Whereas here with this journal entry, what we have happening is this is the employer saying, hey, here's our share of the FICA. Now, when the employer actually goes to pay the government and says, okay, here's the income tax, then they would debit, or let's take the unemployment tax payable. Let's say that the next week they actually paid that to the government. Then they would debit unemployment tax payable to get rid of the liability and then credit cash for $12.